Glencore had an investor update recently, and there were a few interesting takeaways. The first is the company's estimate of the free cash flow that it generates at spot commodity prices and exchange rates. Glencore estimates that it'll generate $7.4 billion at current spot prices in 2018. That implies that at spot, the share is trading at a free cash flow yield of around 11 to 12%, which is a premium to many of its JSE-listed peers who are closer to 15% plus. The story is similar if you look at other valuation measures. That premium in valuation the market's willing to pay could be down to the uniqueness of the commodities in its basket versus peers. The most significant difference being that Glencore has zero iron ore exposure. A new dividend policy was established this year where $1 billion from the marketing division will be paid every year as a dividend, and then at least 25% of the industrial business's free cash flow will be paid out as a dividend as well. Now, given the cash that the business is generating at the moment, there does seem to be scope for materially more than 25% of the industrial business's free cash flow to be paid as a dividend, especially as net debt to EBITDA is comfortably below the stated ceiling of 2 times. Then finally, it's interesting to note how bullish Glencore is on electric cars. The basket of commodities that they're exposed to is pretty well positioned for the emergence of electric vehicles. If the ramp up in production of electric cars happens at the pace forecasted, the world is going to need, amongst other things, much more copper, nickel, and cobalt, which Glencore has material exposure to.